this month in the Business Builder, the Fireside Business Builder, which if you don't know about it, there's a link below. You can go have a look. But this month we are focusing on cash flow. So I thought I would take a moment very quickly to just touch on a point that very few business owners are aware of. And that is that there is a difference between your financial profit and your expected cash in the bank. And this is something you probably are very aware of around tax time. So your taxes are due, your accountant comes to you, they give you your annual financial statements and they tell you you need to pay X amount to your tax man. And you look at the financial statements and you go, but I don't have that profit sitting in my bank. If that's how much money I made, where's my money? And so it's important to know that financial profit on your reports is not the same thing as cash in the bank. And there's a couple of reasons for that, but I'm just going to touch on your top couple, which is number one, the fact that there is a difference between payment dates and the dates used in your accounting. So internationally, the international accepted principle is to record accounting transactions on the day of the document. So you can go buy something, say on the 1st of March, but if you are given terms to pay later, so you can pay in 30 days, you only have to pay that on the 31st of March. But we're going to enter it as accountants, it's going to go into your books on the 1st of March because that is the day that you bought it. That is the date on the transaction documents. So there's going to be immediately a discrepancy between what your accounts are saying, that you went and bought something, something's gone out of your business for stationery or stock or something like that, but that money's still sitting in your bank account because you haven't paid for it yet. And that works the other way around as well. You're going to sell to clients and customers on credit. So you can make a sale and your sales will go up, but your bank balance doesn't change because that client only has to pay you in 30 days or 60 days or whatever your arrangement is. So that's the number one reason why your bank balance and your profit and loss are never going to correlate. But another one is the fact that your profit and loss, your income statement, doesn't show every transaction in your business. And if you're not sure what I mean by that, we do have a little short series of understanding the financial statements, just the 4 basic ones, and you can go watch that on YouTube or give me a shout and we can chat about what they mean. But your income statement only deals with things that directly affect your income, your expenses, your profit. There are other transactions that happen in your business. You could loan the business money, so your bank account is looking healthy, but you haven't actually made a profit yet. You could borrow the money from the business, in which case your bank account goes down, even though you're making a profit. You could borrow money from a bank or lend money to a creditor. You could buy an asset, and an asset is something that goes in your balance sheet because you're going to be using it for multiple years. So it doesn't show in your income statement immediately. So there are things in your business that don't affect your profit that do affect your cash. And that is why your profit and your cash will never align. And it is very important as a business owner that you track both and understand what is happening with both. If you need help with that, give us a shout, even if it's just a 15-minute call so you can understand the ins and outs of how to track, but make sure that you are.